Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, January 13th, and we're talking CPI, rate cut bets, a very loud debate about the Fed's independence, and what JPMorgan's numbers say about the real economy.
I'm your guest, and I'm here to translate macro into, will my mortgage payment stop jump scaring me? Also, if the Fed is getting investigated, do we get a refund on stress?
Story 1. Inflation data came in softer than feared, and markets reacted fast. We saw stocks rise while bond yields fell. Classic disinflation relief rally, and it revived bets that the Fed could cut later this year.
So the vibe is prices are still up, but they're up in a less annoying way, and Wall Street throws confetti? That feels emotionally unhealthy, but financially understandable.
Simple version, bond prices and yields move opposite. If inflation looks like it's cooling, investors think future interest rates may be lower, so existing bonds look more attractive. Prices up, yields down. Lower yields also make future corporate profits worth more in today's dollars, which can lift stocks.
It's basically like if the rent hikes slow down, everyone stops panic buying canned beans and starts shopping for throw pillows again. Markets are the throw pillow.
Why it matters for normal people. If yields fall and that trend sticks, it can eventually feed into lower borrowing costs, mortgages, auto loans, and even business loans that affect hiring. But eventually is the key word. Lenders don't instantly rewrite rates because one report looked nicer.
So I shouldn't sprint to my bank like, hello, I saw CPI and I'd like a discount. They'll just hand me a brochure and a feeling.
Actionable takeaway. Treat this as a recheck your rate sensitivity moment. If you've got high interest debt, prioritize paying it down because rate cuts, if they come, can take time to reach you. And if you're investing, know that falling yields can boost long-duration assets, but it can reverse quickly on the next hot data print.
Don't build your whole personality around one CPI report. Markets are fickle, like a cat, with Bloomberg terminals.
Story 2. Global central bankers publicly rallied around Fed Chair Jerome Powell amid reports of a criminal investigation. And markets are watching this because it touches the Fed's independence, one of the pillars of credibility behind U.S. monetary policy.
Nothing says stable financial system like the words criminal investigation and central bank in the same sentence. That's like seeing fire and sprinklers on a dating profile.
Simple version. The Fed sets policy to manage inflation and employment, but it needs room to make unpopular choices. If investors think politics can force rate decisions, they may demand higher yields to compensate for uncertainty, meaning borrowing could get more expensive even if inflation is cooling.
So even when CPI behaves, the market can say, cool story, but do we trust the referees? And if the answer is maybe, everyone charges extra.
Exactly. We even saw gold hovering near record territory in the backdrop of these independence worries. Gold often benefits when people want to hedge against policy uncertainty or currency credibility risks.
Gold is basically the emotional support blanket of markets. It doesn't fix your problems, but it makes you feel like you own something that can't be subpoenaed.
Actionable takeaway. Don't overtrade headlines, but do stress test your plan. Ask, if yields jump 0.5% quickly, what breaks? Your adjustable rate debt, your monthly budget, your tech-heavy portfolio. A little diversification across cash, shorter duration bonds, and equities can reduce one headline risk.
So we're building a portfolio that can survive both math and drama, because apparently the market is a spreadsheet taped to a reality show.
Story 3. JPMorgan posted results that topped estimates, with trading revenue exceeding expectations, while broader commentary signals pressure points, like how regulation and potential policy proposals could affect consumer credit. One notable angle, banks discussing the possibility of fighting a proposed
A 10% credit card cap sounds like a warm hug for anyone paying 25% APR. But banks are like, if you cap it, we'll just not date you. Is that the threat?
Simple version, credit cards are unsecured loans, so banks price for risk. If you cap the rate, lenders may respond by tightening approvals, cutting credit limits, adding annual fees, or reducing rewards because they still need to cover defaults and operating costs.
So the menu changes, you get cheaper fries, but suddenly there's a table fee, and the ketchup is behind the counter like it's a controlled substance.
Why it matters. For households carrying balances, a cap could reduce interest costs if they still qualify and the product remains accessible. For the broader economy, consumer credit availability can affect spending, small business cash flow, and delinquencies. And JPMorgan's trading strength also hints that volatility has been profitable for big banks, good for shareholders, mixed for everyone else trying to plan.
Wall Street. Volatility is opportunity. Regular people. Volatility is my budget doing parkour.
Quick recap. CPI cooled enough to push yields down and lift stocks. Fed independence headlines add uncertainty that can reprice rates fast. And JPMorgan's results show how banks can thrive in volatility, while policy debates like credit card caps could reshape consumer lending.
Your homework? Check your debt rates. Don't panic trade politics. And if your credit card APR is doing the most, consider a payoff plan first before you start collecting rewards points you paid for with your soul.
If this helped, subscribe to BD Daily Finance News Podcast and share it with a friend who texts you screenshots of CPI like it's celebrity gossip. Drop a comment. Are you more worried about inflation coming back or about policy uncertainty pushing rates higher anyway?
And stick around for the follow-up fortune segment, because if the market is going to act mystical, we might as well ask the universe for a forecast with commitment issues.